Hi, I'm family law attorney Kyle Scoresby. In previous videos, we've talked about dividing up assets and debts in a divorce. We haven't really addressed yet the tax consequences that come with the division of assets and debts in a divorce. And it's important to consider that when you're dividing up the assets. Not all assets are equal. Under Arizona state statutes, courts are authorized to consider the tax consequences of a particular division of assets and to take that into account in dividing the assets. Let me give you some examples. Again, the concept here is that tax-deferred assets are not equal to after-tax assets. That's one of the considerations. As an example, an IRA is a tax-deferred asset. In most instances, house equity is not a tax-deferred asset, or in other words, it's not going to be taxed when it's sold in most instances. So for example, if you have a house with $100,000 of equity that the parties have been living in, and you have an IRA that's valued at $100,000, in the division of assets, if one side gets the IRA and the other spouse gets the house, that $100,000 of equity, when the house is sold and that is realized, will probably be tax-free. The IRA, on the other hand, that whole $100,000 is going to be subject to tax. So the person who gets the IRA ends up with maybe $70,000 of after-tax money, whereas the person who received the house gets $100,000. Similar example would be a 401k. A 401k is a tax-deferred asset, but a Roth IRA is an after-tax asset, and same with a private brokerage account. It would not be appropriate for one spouse to receive a 401k worth, for example, $200,000, and the other spouse to receive a Roth IRA with $200,000 in it. The person who, with getting the 401k in that instance, would actually be receiving much less in after-tax value. Another issue is capital gains that haven't been realized yet. In certain instances, assets were acquired as investments, like a rental home, for example, may have been acquired for $100,000 and maybe now it's worth $200,000. When that rental property gets sold, that whole gain is going to be subject to tax. So in any division of assets, you need to be looking at these issues. A lawyer doesn't have to be an expert. You just have to know that you need to include an expert, such as your client's CPA or other tax advisor.